S&P 500 down 1.52%, closing at 7,316.15. NASDAQ drops 1.74% to print 24,442.94. The Dow shedding over 1,100 points, down 2.19% to finish at 51,594.14.
And small caps got dragged right down with them.
Right, the Russell 2000 sliding 1.61%. Cash market locked exactly 15 minutes ago, and breadth was just absolutely slaughtered out there.
Yeah, because the real risk here isn't just the headline index prints, it's what caused the liquidation.
I mean, on the surface, the Fed held benchmark rates steady in the 3.50 to 3.75% range.
Which is exactly what the street wanted.
Right, you'd think equities would catch a bid on that, but the market basically had a panic attack.
Because if you look beneath the surface, that 9-3 FOMC vote split completely broke the dovish thesis.
3 regional Fed presidents actively dissenting.
And not just dissenting, they were actively demanding an immediate 25 basis point hike.
Right.
I mean, they are terrified of sticky inflation. So, institutional desks realize instantly that the margin for error on inflation is absolute zero. The hawkish undercurrent is totally exposed.
And right as that hawkish vulnerability hits the tape, we get a secondary catalyst that just pours gasoline on the whole thing. Brent Crude surging 7.3% to settle over 88 tons a barrel.
Yeah, the military escalations in the Middle East.
Exactly. And the sector breakdowns on my screen show the immediate fallout.
Yeah.
Energy, your ExxonMobils, your Chevrons, they were the only green sector today.
Reversing all that early weakness.
Yeah, they climbed higher, while the cyclical industrials just got absolutely hammered, sinking 3.42%. But, I mean, looking at the data, I want to push back a little here.
Go ahead.
When there's a scary headline about oil or a hawkish Fed, algorithms react instantly. We see it all the time.
Sure.
How do we know this elevated volume wasn't just, a temporary summer algorithmic flush?
Because the volume confirmation isn't there for a retailer algorithmic panic. This was structural.
You're looking at the exchange internals.
Right. U.S. exchange volume hit 17.7 billion shares today. The average is around 17.3. And on the NYSE, volume was running 22% above its 30-day average.
That is massive liquidity.
It is. Large institutional funds can't just hit the sell button on millions of shares all at once, or they'd ruin their own execution prices. They need a massive pool of willing buyers to absorb those orders.
Which brings us to the midday trap.
Exactly. Look at the intraday tape. Early in the session, the S&P was down about 1.2%.
Right around noon.
Yeah. And before the Fed released their 2.0 p.m. statement, buyers started stepping in.
They bought the dip, managed to erase that entire 1.2% drop, and got the index back to the flat line.
Which looks incredibly bullish if you're a retail trader watching your screen.
You think the worst is over.
But then the Fed statement crosses. That 9-3 hawkish split is exposed. The big desks didn't just passively sell, they aggressively faded that midday rally.
They sold directly into the buying pressure.
They used that retail optimism as a giant liquidity pool, fed their shares right to the buyers, overwhelmed the demand, and just slammed the market straight into the close.
Closing near session lows on 17.7 billion shares isn't an algo glitch.
No, it is high-conviction institutional distribution. Real money, point blank, refused to hold long positions overnight.
And we saw that fear mathematically confirmed in the options market. The VIX just exploded today, jumping 13.45% to hit 20.66.
Breaking right through that critical 19 to 20 resistance level.
But the mechanics here are what's interesting. Usually, when a highly anticipated Fed meeting passes, the event risk is gone.
The uncertainty is removed.
Right, so normally options premiums deflate. You get an implied volatility crush. But today, the exact opposite happened.
Because the Fed statement didn't resolve the uncertainty, it multiplied it.
Options traders realized the macro landscape just got significantly more dangerous.
Right, they weren't just passively selling stocks, they were actively paying steep premiums to buy put protection. The market is bracing for sustained geopolitical supply shocks and the very real threat of a surprise hike.
Okay, so macro fears are squeezing industrial margins, funds are trapping retail buyers, and the options market is buying crash insurance. But I want to pivot to the tape on artificial intelligence.
The divergence here was incredible.
It was a massive contradiction. On the hardware side, it was a total bloodbath. A brutal, bearish key reversal in semiconductors.
Any early attempt to stabilize just totally failed.
Relentless profit-taking. Micron plunged 10.07%. AMD drops 5.51%. Even NVIDIA took a 3.55% hit.
Yeah, the underlying catalyst there was the global tech earnings pressure. SK Hynix significantly missed expectations.
And when you combine that memory chip weakness with the Chinese DUV lithography headlines.
Exactly, the entire hardware CapEx cycle suddenly looks vulnerable.
But then, literally as the closing bell rings, Microsoft drops its earnings, and it's an absolute monster quarter.
A phenomenal print.
Q4 revenue beat at $90 billion, up 18% year over year, driven by a 27% growth in Microsoft Cloud, hitting $59.3 billion.
Pulling those numbers in this macro environment is a testament to their structural dominance.
But hold on, this is where the logic seems completely broken to me. NVIDIA, AMD, and Micron are crashing. They physically build the data centers.
Yeah.
So how is Microsoft's AI and cloud software business booming to this degree when the hardware sector is getting liquidated? Aren't they tied to the exact same ecosystem?
They are, but institutional capital is hyper-aware of the distinction in their business models.
The asymmetric trade.
Precisely. Remember why the broader market sold off today? It was cyclical macro fears.
Yeah.
Higher oil, threat of higher borrowing costs.
And hardware manufacturing is highly cyclical. You need raw materials, factories, massive capex. They're totally exposed to inflation and rates.
The hardware supply chain feels that margins squeeze instantly. But enterprise software, the demand for cloud platforms is completely intact.
Corporations aren't canceling their cloud migrations just because Brent Crude went up $6.
No, they aren't. Big money is looking at this panic and executing a massive rotation. They are using the sell-off to buy fortress balance sheets like Microsoft on a dip,
High-margin software revenue that defies geopolitical gravity.
while simultaneously shorting those capital-intensive, lower-margin cyclical stocks. They aren't abandoning AI. They are migrating up the food chain.
All right, so that brings us to the actual execution for tomorrow morning. We've diagnosed the distribution, but let's talk key levels.
The 7,300 support zone on the S&P 500 is everything right now.
We printed 7,316.13 at the close, so we were resting right on top of it.
It's a massive gamma wall.
So mechanically, if 7,300 holds, dealer positioning forces them to buy the dips, creating a safety net.
Right, because of how they hedge their put exposure.
But if we decisively break below 7,300, that mathematical exposure flips.
The safety net becomes a trapdoor. Dealers are suddenly forced to aggressively short the market to remain neutral, and we plummet straight towards 7,250.
So what are the probabilities of testing that trapdoor tomorrow at the open?
Historical data suggests a 55% early downside bias following this kind of volume. The hangover effect from institutional distribution usually carries into the next morning.
But you can't just blindly short the open.
No, absolutely not, because Microsoft's $90 billion print introduces massive conflicting overnight flows.
You've got Wednesday's macro gravity pulling down, colliding with Microsoft's software resilience pulling tech up.
It guarantees a highly volatile first hour of chop.
Which is why the focus is on two specific day two plays. The first one is the gap and go on Microsoft.
Right, a fundamental repricing event. If it gaps up and holds those highs in the first 15 minutes, large mutual funds are going to be structurally forced to adjust their portfolio weightings,
creating sustained buying pressure. But the second day two setup, I had to challenge this one.
the Ford setup.
Yeah, amidst a massive tech storm, oil spiking, VIX breaking 20. One of the standout institutional buys is a legacy automaker. Ford surged 2.14% to $15.28 today,
On 92.2 million shares.
which is 44% above average volume. But it violates the entire premise of our macro analysis. High oil and high borrowing costs crush industrials. People finance cars with debt. How is Ford a buy?
It's the ultimate macro paradox, but it's driven entirely by free cash flow. They didn't just beat earnings, they raised their full-year adjusted free cash flow guidance.
Through internal restructuring and margin expansion on commercial vehicles.
Exactly. When large funds see a company expanding margins and generating billions in free cash while the rest of the industrial sector is choking, they rotate in.
92 million shares changing hands isn't retail. That is massive institutional accumulation.
At $15 a share, the big desks decided Ford's cash flow was a safer harbor than speculative hardware. If it breaks above today's high of $15.28, that accumulation is continuing.
So, distilling this down for the active traders out there, today looked like a blind panic, but it was actually highly calculated institutional reshuffling.
The hawkish crack in the Fed, the geopolitical oil spike, and that sharp rotation from AI hardware into cloud software.
You can't just look at the red index prints. You have to watch the volume, respect the 7,300 gamma wall, and track the asymmetric capital flows.
Which leaves us with one critical structural risk to stress test going forward.
If a mere hold in rates, with just 3 dissenting votes, can trigger this much distribution and wipe 1,100 points off the Dow.
What happens if the next inflation print actually forces their hand to raise rates?
If the threat of a hike opens a trapdoor, an actual hike could be catastrophic. Watch your risk, watch that 7,300 level, and we will see you at tomorrow's close.